Come on, 2, 3.
Well, good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN Weekly for Saturday, December 18th, 2021. And our top story today, what does the retirement marketplace look like in 2022? We'll take a look. Joining me now to discuss this and a lot more, Randy Plovica is a journalist at With Intelligence. Randy, great to see you. Happy holidays. Thanks so much for joining us on the program this morning.
Of course, same to you, Jeff, and always great to be on here.
Yeah, it's great to talk to you. And yesterday we had a show about looking back at the top business stories of 2021, but this time with you, I want to look forward into the retirement outlook for 2022, which it's hard to believe it's 2022 coming up around the corner. But let's talk about a couple of things. I'm going to throw out some concepts and you give me your perspective. First, personalization. What's Randy's take?
Yeah, I think right now it's been really interesting to see. Managed account development is ever ticking upward. A lot of firms getting into that, and a lot of TDF managers still prioritizing it in their design. Every conversation I have, it seems to arise in some way or another, whether it's in the product design itself, right? Managed accounts giving you kind of fully tailored options, or in the marketing and messaging. I've seen a lot of firms that want to go as granular as one-to-one communications with participants nowadays to make sure they are well situated with their retirement investing journey, right, to make sure they're on track, and even introducing tiered systems of communication in which they can address a whole wide swath of scenarios, both emergency and standard. So I think personalization has been a really fun one to see develop, and I think, you know, heading into the new year, you're not going to see any slowdown of that word, both used in whether it's development side or just in terms of the marketing that a lot of these firms are doing.
Randy, I want to mention two words, financial wellness. Does this dovetail into that? Is that part of that broader conversation? You know, I hate buzzwords similar to you. Holistic, financial wellness, cybersecurity, buzzwords, in my opinion, it's where the rubber meets the road. But is this part of that bigger trend? People want individual tailored solutions for themselves.
Yeah. No, I definitely think it fits with that, right? And although financial wellness as a word can mean a whole slew of things, I think what's nice is that a lot of these firms are taking it seriously, right? When they want to offer somebody a quote unquote holistic picture, they do want to take into account every asset you own, every investment you have, every part of your investing journey, whether it's just getting yourself to retirement or taking care of kids, grandkids, or beyond, right? I know that not everybody has what I would say like a linear spending journey. And so I think nowadays the investment picture is definitely evolving, right? And you get a whole swath of options that come into that too, right? We saw the rise of HSAs in recent years, a lot more firms diving in there. And I think it's going to continue. So to your point, right, a lot more stuff around cybersecurity, around digital tools, around education online. I'm sure the webinars and the podcast will not slow either.
That's true. That's true. Randy, let's talk about, you hinted to it, investment evolution. What about ESG? What about private markets? Where does that go in 2022?
Yeah, this is actually a really interesting year. I've been having a lot of conversations with target date fund managers. It's probably the most that ESG or private alternatives have ever been mentioned. Now, I could be the one driving that mention when I'm asking them questions around it, but the point is that they're kicking around a lot more research around it, and a lot of them are putting a lot more action toward it than before. So I work with about the top 15 or so target date managers, and I think every conversation I've had, the bulk of them are either actively looking at bringing ESG or private alts in, or are at least seeing what that might look like, right, on the custom side. So even if it doesn't fit into their traditional picture for them, they want to know how they can be a part of that, basically a part of that cycle, right? And make sure that they're staying on topic of whether it's a trend or really making sure that you're diversifying the investment. It's been very interesting. I think we're going to see a lot of fun developments in the new year. Hopefully some fun either A, press releases or B, launches from these firms, depending on their timing of what they're going to be doing. But I don't think that ESG and private alts, the conversation that we had in 2021 is going to stop anytime soon. And obviously very much hoping to see some progress there that's meaningful and hopefully transformative, right, for the retirement investor at the end of the day.
Randy, diversification, always an important concept, and you mentioned it with ESG, private markets. What about cryptocurrency? Something that's really taken off, or at least gets a lot of press in the retail space. Hasn't really found its way to the retirement investor, at least in the U.S. retirement plans like 401k, 403b. How about that? Where do you think that stands in 2022?
Yeah, I think there's two lenses to take it from. And the easiest one is the institutional plan lens. I think right now those plan sponsors that are handling very large institutional grade defined contribution plans are still not saying not trying to figure out, but more so trying to figure out where it might either A, fit, or what they need to do to be educating their basically their plan participants around it. I think it's a little bit early innings to tell what they're doing, but I think on the retail side, there's a lot more interest. And to your point, a lot more retail investors see it as kind of a viable means of either raising their own assets, having a little bit of fun with investing, or just, really seeing where it goes, right? We saw some explosive growth with crypto in the past 5 years. And I'm sure that there's no shortage of tweets about, sending the next crypto to the moon, or whatever their phrase is now that they're using. But the point is, I think crypto is going to be interesting in how it gets into the retirement picture. I think it might almost factor in the same way that kind of having outside assets does. I don't know if it'll fit perfectly in a target date picture or in a traditional 401k, but I think it's going to have to be one of those outside assets until the kind of fiduciary liability can be firmed up in a way that doesn't threaten a plan sponsor, a consultant, an advisor, and really doesn't put anybody on shaky ground with any type of regulatory system.
Yeah, I kind of view it as more alternatives. Randy, I can't let you off the hook in terms of investments without asking you about retirement income. You and I have had a lot of conversations this year about annuities, annuity-like products. Where does it go in 2022? Does everyone just say, hey, we need something, let's adopt it? Or is it still this slow, meticulous chipping away at the, at the decision-making process?
Yeah. I mean, my hope, right, is that we see actual launches in this space, and we see more than a handful of products kind of enter the marketplace. Now, if that happens or not, I think it's going to depend on kind of the firms that I work with and how they iron out their own plans. I think so far the interest is very much there, right? Ever since the Secure Act got passed, I think everybody's trying to figure out what they can do meaningfully in this space to kind of make themselves different. From the asset management side, right? I don't think any two firms want to offer the same product. And so I think once something's in the market, everybody's trying to bring their own flavor. That being said, I'm pretty optimistic that we're going to see a little bit different flavor of retirement income in the new year. Stuff beyond just a traditional, when I say traditional, but like an annuity bolt-on, right? That seems to be the common path that a lot of managers have taken to date. And I think that we'll see a little bit more creativity around what that kind of retirement income picture looks like. I've heard it talked about as potentially adding a share class in the target date picture that allocates toward a retirement income portfolio and really generates that for a firm. I've also heard stuff talked about like basically offering a marketplace of annuity options. And there are some firms already doing something in that realm too. But the point is, I think it's going to come down to, we're going to have a kind of a Baskin-Robbins approach, right? We have the 31 flavors of retirement income, and hopefully that'll be a good thing for the retirement investor, right? I think more choice is better than less. And the more, I guess, unique approaches we get, then the more options people have out in the workplace to kind of make their choices when it comes to decumulation capabilities.
I like the Baskin-Robbins analogy. Last question, Randy. I can't let you go without asking Randy Plavaika's wish list. I mean, we've talked about some great things: personalization, investment evolution. I didn't even mention CITs. I wanted to get to that. Maybe we'll do that later in 2022. But what did we miss? What's on Randy Plavaika? You've covered this beat for a long time. What's on your wish list for 2022?
Yeah. I'm really hoping to see the next evolution of target dates. And I think it encompasses a lot of things we already talked about, whether it's private alts, ESG, retirement income. I really want to see the vehicle evolve. We've seen a lot of really awesome things done in the managed account and custom format. I think there's a lot of potential to kind of bring that into the traditional target date space, right? I think, having just one offering, right? Just having one approach isn't going to cut it anymore, especially when investors want at least a couple different options to choose from, right? They're not going to just want option A because everybody gets option A. They want options A through Z. I think in terms of like a meaningful wish list, I would like some better clarity around the usage of ESG in defined contribution plans and how that might be a little bit more seamless. I would like a little bit more allowance for private alternatives as it makes sense for diversification, because I do think there's merit and value, right? When you look at kind of the success of defined benefit plans, defined contribution plans really can't mirror that perfectly yet. And I think the closer we get to parity, right, and the closer we kind of bring those two together, I think it'll make meaningful progress and help retirement investors at the end of the day, as long as it's done with diligence, done effectively, and done in a way that benefits the retirement investor and not just the person collecting the fees at the end of the day, right? So all that being said, kind of my wish list is for a better retirement journey for everybody. And although it's more of a cold wish or a cold take to be making, but I think more of a solid one, right? I don't think I'll end up with coal in the stocking this year by putting that on the list.
Oh, I hope not. I mean, we don't want coal in anyone's stocking, and there's a lot of work to be done. But I use that analogy of chipping away, and I think we've been doing that for 30 years, but maybe time to up the game more. Randy, I hope some of your wishes come true, although unfortunately I can't grant them, but we can talk about them. Randy Plavaika, always great to talk with you. Thanks for breaking down what you think is going to happen in retirement 2022. We look forward to having you back on the program again in the new year.
Thanks so much, Jeff.
Thanks, Randy. Great to see you. Thanks for sharing your perspective. And when we come back, we'll take a look at some of our best segments for the week. You're going to want to stay tuned right here on BRN Weekly. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Are you stuck with a low credit score? A credit report and score that's causing you to be denied credit or pay higher interest rates than others for the same things? Then do what Terrence did and call Credit Repaired for your free credit evaluation to help restore your credit.
I started thinking about buying a new house, and my score wasn't where I needed it to be. I called and spoke with one of the representatives, and we just had a good conversation, and I liked what he was saying.
Just one call for his free credit evaluation was all it took to start back on the track to repairing his credit.
I'm seeing the deletions and I'm getting the report, so I know something's being done. It does make a difference to me.
All it takes is one call to get started.
Credit Repair has given me a second chance to have a better credit score.
Don't let a low credit score hold you back another day. Do what Terrence did and make the call for your free credit evaluation.
Call 800-819-4152. That's 800-819-4152. Again, 800-819-4152.
Welcome back. On Monday, we discussed the Supreme Court reviewing a very important retirement plan case. Let's take a look.
So this case, it's Hughes versus Northwestern University. And the case is a big deal because it's part of a wave of fee litigation, excessive fee litigation that we've seen both in the private sector, ERISA plan, 401k plan context, and we've also seen in the 403b world. Northwestern University offers a 403b plan, which is, with very few differences, it looks a lot like a 401k plan. Mm-hmm. And what's going on is that, we've seen kind of cases like this brought around the country that allege essentially that the investment options inside the plan have fees that are higher than other investment options that could have been picked. Either they're higher than, an identical investment product with a different share class, or they're higher, more expensive than an investment option that the plaintiffs view as comparable. So sometimes this can mean an investment managed by a different manager. Sometimes it can mean a passive fund as opposed to an active fund. But the fees are higher, and that is essentially the plaintiffs are arguing that that's a breach of fiduciary responsibility.
So
the other aspect of these is record keeping. And in many cases, or in some cases, the fees that are paid in investment options help offset some of the record keeping costs. So these excessive fee cases can challenge both the investment product fees themselves, but can also challenge, how much it cost, to record keep for the plan. One of the great things about the Supreme Court is that it brings uniformity. And part of that process is they wait until there's been a lot of these cases. So, we said there's been a wave of fee litigation, and there's been a wave of fee litigation. We've seen district courts all over the country make decisions on fee cases that have been relatively inconsistent. We've seen circuit courts, which are the courts of appeals, make decisions, and they're somewhat inconsistent as well. And then the Supreme Court steps in, like they have here, to put in place a uniform standard across the country, and they wait until they've had these other courts make decisions, because it provides them an opportunity to see how other people have decided it, because they'll read those lower court decisions. It also affords them an opportunity to really wait until the issue all the thoughts have been fully developed. So they'll get briefing on essentially all of the issues in there. And then, really the last step is you've got the litigants counsel on both sides, and they appear before the court, and the court asks questions from both sides, really to poke holes, to understand, to play devil's advocate, to try to address concerns maybe that other justices have about, how the case should be determined. Now, listening to oral argument, it doesn't always provide a clear indication of what the outcome is going to be. And sometimes you listen to oral argument and then you read the decision, a few months later, and you realize, wow, when that justice was asking questions, they were being a bit of a devil's advocate. They were asking questions that were tougher on the side they agreed with than the other side. So I've got to caution that. Here, I think some of the key takeaways are that the court seemed pretty skeptical of arguments that having too many investment options in a plan by itself would be a breach of fiduciary duty. So the plaintiffs were pointing out, this plan has more than 40 options. Why do participants need more than 40 options unless the plan fiduciaries are trying to, avoid responsibility for picking individual investments? The justices didn't seem to be going for that argument. Some of the justices seemed to think that if there's an identical investment option, so if you've got the same manager with a less expensive share class that's readily available, that if a prudent fiduciary really ought to be picking the lower cost share class if they're identical. We'll have to see how that gets decided. But in terms of having similar options, it seemed like there was a lot more diversity of thought from the bench. Chief Justice Roberts had a great analogy where he was talking about, if I lent him my car, would I expect him to drive to Baltimore from DC to find the cheapest gas? Or would I expect him to, go to the neighborhood gas place or a cheap gas place that he happens to drive by in a typical day? And it seemed as though he was pointing out that if we hold fiduciaries to a standard of they've got to find the cheapest investment option on earth or the best investment option on earth, that's really an unworkable standard. And that what we would expect of somebody who we do have a relationship of trust and confidence with, like if I lent you my car, Jeff, I would have a relationship of trust and confidence, but I still wouldn't expect you to scour the earth for gas stations. I would just hope you came back with a full tank. I think that fiduciaries don't get much out of running a plan, unlike you would get out of borrowing a car. But I think one of the things is that, Chief Justice and Justice Kavanaugh expressed some concern for the rising number of fee cases. And they flagged some of the difficulties we're seeing in the fiduciary insurance market. So I think the key takeaway here is that we're likely to see, a clearer articulation of how much a plan fiduciary is expected to scour the market, how much they're supposed to, how often they should be conducting fee benchmarking, and, whether a plan fiduciary should be viewing a certain number of investments as too many in a planned lineup. So to me, this is great news, because one thing about ERISA's fiduciary duties is that they can be fairly, vague and flummoxy. So hopefully after this, there's a clearer standard for what a plan fiduciary should do when they're making investment decisions. In the 403B plan context, sometimes you have legacy investment options that participants have chosen and they like. If you switch record keepers in order to keep access to some of the annuity products or other products that folks may want in that 403B plan, you may need to keep that legacy record keeper, at least for maintaining the options that you already have. So, it's going to be, it's going to be interesting to see how the court addresses that issue. They seemed amenable to the idea of multiple record keepers possibly serving a positive purpose. But one of the nice things about the Supreme Court is that I can speculate, but they'll provide a decision. And once they give that decision, they're not final because they're right. They're right because they're final. So whatever they say will be the case.
And on Friday, we analyzed the top business stories for 2021. Let's take a look.
When Flipboard was compiling its top business stories of the year for our annual year in review section, not surprisingly, inflation was our number one choice. It's a big story that impacts everyone. It impacts corporations, it impacts governments, and of course it impacts you and me and all of your listeners. It hits our pocketbooks. So we feel it directly, and it's definitely it is the top story of the year. Washington sees what's happening. I mean, gas prices are up 58%. Fuel oil is up 59%. So everyone's feeling that as we go into winter. People are seeing their fuel oil prices rise. So yeah, Washington is definitely reacting. The Fed indicated yesterday that it likely will raise interest rates several times next year. What's interesting is the stock market so far, some people thought the stock markets would go down on this news, but so far they've actually gone up a little bit or have remained steady. And I think the thinking there is that Wall Street expected this to happen. So they kind of were already prepping for this. And that was kind of, as you said, kind of baked in to what the markets are doing. I think it's surprised a lot of people. I think a lot of companies thought once the pandemic ended and they reopened, people would come back to work. But the problem, as you said, we've 11 million people quit their jobs in October, but we only have about 7 million people unemployed. So there's a huge gap. There aren't enough people to fill the roles. And there's a lot of different things going on here. People want more money. So there's definitely pressure to increase wages, and people are holding out for higher paying jobs. And I think, the pandemic, and we've discussed this before, the pandemic caused a lot of people to kind of question their career choices and what they're doing. So a lot of people are kind of sitting out or, holding out. And the pandemic itself, of course, some people still are a little hesitant to go back to work. We have long COVID survivors who maybe are unable to work. So many factors affecting the job market right now. So it's really tough for companies to fill a lot of positions. This definitely relates to the two things we just talked about, inflation and the job market. The supply chain is affecting everything. I saw a great analogy in New York Magazine about inflation and the economy right now. And I saw this on Flipboard. And the analogy was, think of the economy as like the world's largest Ouija board, and you've got billions of hands pushing that device around on the Ouija board, and including U.S. consumers. You've got Russian oil oligarchs. You've got Asian factory workers. So many factors going into this, and nobody knows where it's going to land. And that's part of the issue with uncertainty and kind of inability to predict what's going to happen with the supply chain. And inflation as we go forward.
And that wraps up this episode of BRN Weekly. Have a topic of interest, someone you think we should talk to, drop us a line. And don't forget, for all the news in lifestyle, wellness, finance and tech, and a lot more, check out our daily newsletter, The Morning Pulse. Want to see our latest content or search our archives? Check out our streaming partners, Amazon, Roku, and over 100 more. We're back again tomorrow for BRN Sunday. I'll be joined by members of the media, academia, and financial services as we analyze the news for the week. You're not going to want to miss it. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes. Now is your opportunity to co-create content around any topic on the first lifestyle and wellness network. Reach a global audience through our platform and co-own exclusive branded content. All of our programs are available on demand and also as audio-only podcasts, so you can take us on the go. Broadcast Retirement Network, available anytime, anywhere, and on any device.
Are you being audited? And do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and reduce your stress. The IRS can freeze your assets and seize your bank accounts, but you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a Tax Doctor now for a tax emergency analysis.
Call 800-224-6439.